have a fantastic, I'm going to call him advisor, but he's much more than that. Mr. Kanabar, or Dinesh Bhai, as he's known to most of us, who is a stalwart. He really needs no introduction, in both in corporate circles and in the business world. He's recognized as amongst the top tax advisors in India over the past many decades. But he's an entrepreneur himself. He founded Dhruva Advisors LLP in 2014, a tax and compliance firm. And like a true startup, Dhruva has shown remarkable growth over its short lifespan. It now operates through a network of 7 strategically located offices in key regions in India, along with offices in Dubai and Abu Dhabi, with a stellar team of 15 partners, senior advisors, 11 associates, 30 principals, and over 300 exceptionally talented professionals. So he has truly scaled what he has founded in the spirit of startups. It's known as a tier 1 tax firm in India and has been recognized as India Tax Firm of the Year for over 5 consecutive years, which is quite a record in itself. Prior to founding Dhruva, Mr. Kanabar has had an exemplary professional career spanning over 4 decades, where he's held series of leadership positions across several large and prestigious organizations. He was the Deputy CEO of KPMG India, Chairman of KPMG's tax practice, Deputy CEO of RSM, Head Tax and Regulatory Practice at PwC. And he served on several committees and contributes immensely to the ecosystem by sharing his vast experience and knowledge. And he's a familiar figure on the business channels. We particularly look forward to his post-budget commentary. And when a person of his stature agrees to talk about tax issues of startups, it means that our startup ecosystem has come of age. And we need to navigate the complex issues of compliance and regulations, which one thinks only need to be navigated by large corporates. So it's indeed a privilege that Mr. Kanabar will decode all these challenges and also point out to the various opportunities for startup founders and investors. So I'm going to hand it over to Mr. Kanabar to really, give us an overview of what are the key issues related to startups, the key challenges that we keep bumping across. I'm particularly going to ask him to talk about angel tax, which has really flummoxed us with its lack of clarity, to put it bluntly. The various structures for startups that we are sort of sometimes confused about. The tax issues, even though people talk about losses in startups, that's not true. We also have issues around taxation that one has to be wary of and careful of planning. So, host of issues. I think we couldn't have gotten a better person to get us deep into this. So over to you, Dinesh Bhai. And as he speaks along, I may stop him for a couple of questions. For the audience, if you have questions, please feel free to post them on the chat. And as we go along towards the end of the session, I will pick them up and we'll try to get most of them addressed. So over to you, Dinesh Bhai.
Thank you, Paula. Thank you, Ninad and CII, for having me on this important session. Before I delve right into it, Paula, thank you for a very, very generous introduction. It feels good to hear people talk about us in the same breath as you talk about startups. As I look at the title of what we have got, discussion on sticky issues, if I may dare say, Paula, one thing about tax people is that we try to make everything sticky. We believe that we need to confuse people. We need to ensure that people sort of get caught into a vortex and from which they keep on litigating. And the startup ecosystem is no different at all. A quick first snapshot at which all of you participating on this session are more familiar than I am. We are looking, as Paula rightly mentioned, about a system which has come of age, a system which has contributed immensely to the new FDI which has come in this country, which has created an ecosystem of its own, created unicorns of their own. We have seen challenges in the recent past about funding, whether there is a drying up of the funding, and we'll talk a little bit about that, and whether tax is contributing to all of those. But the numbers are right out there. I don't need to repeat that, but we have a fairly large ecosystem. It's not a small ecosystem. Whether it is mature or not is a question of a journey. As Paula mentioned, it's the third largest ecosystem in the world. But suffice to say that there are enough and more numbers, and there are issues which concern both the ecosystem itself and the investors in the ecosystem. And as we go ahead over the next maybe 40-45 minutes, what I'm going to do is to talk about angel tax, which Paula referred to. I'm going to talk about the exemption tax exemption, which is available to us. We have a very specific provision relating to startups, which is from lapsing of losses, if there is a change in shareholding, and what does that mean to us? A very, very important topic we all get caught up with, which is ESOP taxation. Finally, I'm going to talk about long-term capital gains tax investment from investment in startup. And I'm also going to talk about, from an investor perspective, something which we see ever so often, which is inversion, where Indian startups want to become foreign-owned and foreign startup wants to become Indian-owned. And what are the factors which drive that? That's a broad breadth of what we are going to talk about. So, how does India define startups? And we have a DPIIT really coming out with a definition to say that for any startup to seek any form of a tax relaxation or an incentive, it has to be constituted either as a private limited company or a public limited company, or a partnership or a limited liability partnership. So these are the entities which are entitled to be constituted as a startup. And the recognition is for a duration of 10 years. Your turnover has to be less than 100 crores of rupees. And any dilution in 10 years will mean derecognition right from the date of incorporation. Meaning that the government expects that through this 10-year journey, you will never exceed 100 crores, you will be startup and you will be a small entity. Which again is a mindset issue. In fact, as we go and talk about DPIIT and the ministry's recognition, I just get reminded of how much the government wants to continue to exercise its control, whether it is in defining, whether it is in granting benefits, etc. But here we are told that don't exceed 100 crores. If you exceed 100 crores, you are not a startup. And then you need to demonstrate that you are actively engaging activities related to innovation, product development, process improvement, etc. We are also told that you should neither have a holding company nor a subsidiary. So you can't come back and say that I'm doing, for example, a part of the activity which is regulated, for which I need a separate subsidiary, although the regulations may require there be a separate subsidiary. And I can't have a holding company in India. So I need to be a stand-alone company. And where is this possible? Where is this not possible? We'll talk about. And then we are told that resident Indian promoters, I've used the word Indian promoters, but that means really resident Indians should hold 51% equity, and the entity should not be a restructured entity, which is quite understandable. But really, what we need to start thinking through is how relevant is this definition as we evolve, and what are the consequences of the fact that if I lose my recognition in year 7 because my turnover goes up, how do I sort of make up for all the exemptions which I got during the earlier? If you are a recognized startup, what does that mean? And what it essentially means is that you are exempted from the angel tax framework. And what is angel tax? Very simply, and I'm sure all of you on this webinar are aware of that we have section 56, 56 to 7B to be more precise, which says that if shares are issued by a startup at a price which is in excess of its fair market value, then that excess will be treated as income in the hands of the investee company. And while that provision was originally brought about because government felt that there was investment which was being made which was incorrect, to take advantages, to make black money white and whatever else. So originally it was initiated for the purpose of resident investors, and in a Finance Act of 2023, it was enlarged to include investment by non-residents also. So what is now provided is that if you are recognized as a startup by DPIIT, as per the earlier slide, and you fulfill all of those, then the aggregate amount of paid up capital and share premium, if it does not exceed 25 crores of rupees, then that investment is to be not scrutinized for the purpose of section 5627B, meaning that the fair market value proposition will not apply. And if, however, you get investment from non-residents or venture capital company, etc., then that 25 crore limit does not apply to the investment made by the non-resident investor. So two separate criteria. For a resident investor, 25 crore rupees criteria applies. For non-resident, any amount can be invested. So if you are recognized by DPIIT, then no scrutiny will happen and under section 56 to 70. Now, in order that you qualify for this 56 to 7B exemption from being scrutinized as an angel, there are further requirements. And the requirements are that the startup must not invest for a period of 7 years into specified assets. So the startup cannot invest in shares and securities or make contribution to any other entity. So if I go back and just take you a minute back, we said that you cannot be a holding company or a subsidiary, which means that a startup cannot have a subsidiary. Now, however, if you want to enjoy this exemption from angel tax, then you cannot hold a single share of any other entity. You cannot have 1% share in an LLP whatsoever. If you do that, then you don't qualify for this 56 to 7B exemption. Similarly, you cannot invest in land and building other than the land and building which you use for your own business. You cannot buy a car in excess of 10 lakhs of rupees. You cannot invest money in jewelry. You cannot give loans and advances other than your own. So what the government is trying to do here is to say that the monies which you are using are for your own business and are not diverted elsewhere, and therefore you do not use a startup and a recognition by DPIIT for the purposes of getting out of scrutiny. And again, if any of these conditions are violated, then with retrospective effect, all your exemptions are revoked and you are liable to be reopened on everything that you do. So again, the question is, as a startup, do I really want all of these exemptions? Do I not want all of these exemptions? Are these exemptions fetters? And are all of these exemptions designed to ensure that I continue to be a startup and I never really mature during this 10-year or 7-year framework within which I need to comply? Let's move on. So here is, so by definition, a unicorn will never ever fit into the startup criteria because toward 25 crore investment, etc., all of that will go away. And the earlier point which I made is that many of the startups look overseas to expand their business. I've developed a technology. I believe I can use that technology overseas. Now I can't invest in any securities, and therefore I can't invest in any overseas securities. I can't do any inorganic expansion. If I'm providing a car to one of my employees, I got to ensure that the car is less than 10 lakhs of rupees. So really, we are straight-jacketed and probably really many of these restrictions might mean that I don't want this exemption. I might as well live with the situation that I'm scrutinized for whatever investment happens. I'm okay to be not regarded as a startup within the meaning of DPIIT and within the meaning of section 56 to 7B. There's another interesting issue that, assuming for a moment that I am a startup, I qualify under 56 to 7B, can I be easy about investments which are made? And the answer, unfortunately, is no, because we have another section under Income Tax Act, which is section 68, which speaks about unexplained investments, which the tax office very frequently throws at us to go back and say that, sorry, you need to prove the funds from which the investor made an investment. And if you are unable to prove where did the investor in your entity get the funds, and therefore they were not your own funds which you are rerouting, etc., then we are going to make an addition. And again, really, that's a thing which continues to stare us. So merely qualifying as a startup within the meaning of DPIIT or getting an exemption from 56 to 7B, which itself is too onerous, does not really mean that we can sleep in peace and say that income tax is not going to be bothering us. Now, which are the entities from whom investments are made, notified entities to whom angel tax will not apply? So the overseas investments which I mentioned, investments by government, regulated entities, banks. I mentioned about non-resident entities, but again, all of these again we need to see that, and again, if I'm getting money from overseas, they have to come only from SEBI registered FPIs, endowment funds. The investment cannot be routed from jurisdictions like Singapore, Mauritius, or Netherlands. And again, there is this classic debate as to whether investment by notified funds, does it have to come from the fund itself or can it come through SPV? So we are just looking at multitude of knots which have been thrown around us, and if we fall into trap of any of them, then we do not qualify for these exemptions.
Dinesh, can I quickly intervene for one question? A lot of us now invest through SPVs, through Angel List and other such vehicles. Where do they fit in? Is there full clarity? Because most legal opinion is that it's better, instead of coming as an individual investor, come through an SPV, which is...
Yeah, and a good question, Paula. So if you look at this, so if you are a domestic investor, then the exemption does not apply unless your investment is less than 25 crores. So the moment you say that overall funds raised through share plus premium from resident investor is more than 25 crore, then nothing, it doesn't matter whether you are coming as an SPV, you are making a direct investment, or through a registered entity. The registered entity comes in only for investment by non-resident. And those again are specified here, which is SEBI registered FPI, endowment fund, pension fund, etc. Let us go to a situation where we are now talking to say that I am not an investor to whom DPIIT criteria applies, and therefore I am not a registered startup. I am raising funds. And then if I am raising funds and investments are made into me, then valuation norms apply. The valuation norms are prescribed under Rule 11 UA, and those were relaxed very, very recently. Earlier, if you were a resident investor, and sorry, Paul, I must just go back on one interesting point which I made earlier, which was that you could have a situation where you are raising funds at the same time. One is you are raising funds from a qualified foreign investor to whom no criteria applies, and you are raising funds from a domestic investor to whom criteria applies. And the question is the government right in making a distinction between the two? And if both of those have invested at the same price, at the same time, can you challenge one and not challenge the other? So again, that's interesting, and that will come again as we go along and talk about the valuation methodology. So a very peculiar situation, an Indian company raises 100 crores of rupees from a foreign investor at a particular price. At the same time, it raises 30 crores of rupees from a domestic investor. To the domestic investor, exemption does not apply. To the foreign investor, exemption applies. And if both have invested at the same price at the same time, following the same methodology, the tax office cannot touch the foreign investor, but can touch the Indian investor. So we're looking at a very, very peculiar situation. Coming back to what I was talking about, which is to say that assume for a moment that I am now not covered by DPIIT's criteria of a startup, and I am a startup, I am raising funds, I need to justify whether the amounts invested in me are following 11 UA, because if I get anything more than 11 UA, that will be treated as my income of the startup and I will be subjected to tax on it. Now, earlier the requirements were just two, which was tax book value or discounted cash flow. or if shares were issued to a venture capital company or a venture capital fund, then a price matching. Now, very recently, 2 months ago, the guidelines were relaxed, and we now have 4 other methods, which is comparable company multiple method. So I can go and say that somebody else, which is a similar company in my business, has got a multiple of so and so. I have got the same multiple. Therefore, the price at which I have raised funds is appropriate. Second is probability weighted expected return method. Therefore, if somebody is expecting a return IRR of 12%, is that what is matching, not matching? Option pricing method, milestone analysis method, or a replacement cost method. So my ability to satisfy the tax office and go back and say, maybe I am not covered by DCF, maybe DCF does not apply, maybe my tax book value is not there, I'm getting much more than that, but I can substantiate whatever I have got using these 5 other methods. So in a sense, a relaxation to go back and say that not these 3, but other 5 apply. And if I can demonstrate, then I should be kosher. The problem which comes up with these methodologies is that so you get a investment, a merchant banker valuation report. The valuation report should be relevant within 90 days. You have to fulfill all those criteria. But the question is this binding on the tax office? So I have got these methods. I fulfill those methods. I obtain a merchant banking report and I file it with the tax authorities. And what we have seen in practice. So in theory, this is a very good welcome amendment. I had spoken about it at length on interviews on this to say this is very, very welcome. In practice, the challenge which happens is that the tax office very often then not comes back to say, I challenge you on this particular method. And then when they challenge you on that method, it gets into a litigation. There have been fortunately several judgments of the tax tribunal. This hasn't gone to courts as yet, but there are several judgments of the tribunal which have gone back to say that a tax officer cannot suo moto come back and say, I disregard. He has got to refer it to a valuation cell within the income tax department and come back to say why something which has been put by the investee company is not acceptable to the revenue and what is the basis on which they are disputing. But all that I would go back and say is, and this is a question which comes up in many other contexts, not necessarily startup, that we have principles which are very laudable. When it comes to implementation of those principles and policies, how do they get implemented? Do they frustrate the policy or not? So in principle, here is the government coming back to say, we do not want startups to be unnecessarily burdened with having to prove that whether they raise funds in the right pricing or not. We agree that startups have different bases of valuation. DCF may not be the only right basis, and therefore, if they can satisfy this on any other of the 5 criteria, that works very, very well. However, in practice, ever so often we find the tax office come back and say that we want to challenge the valuation, and then it gets into a litigation.
Dinesh, on this issue, which is really, I'm sorry to just keep coming back to it, but this is something that was bothered us a lot because a lot of us have been on the other side. And do you see a shift? Because the government has come with clarifications a couple of times, but we still seem to have the same thing on the DCF and comparing it with, you're making losses, how are you getting? And we've had funds frozen in companies and so on. Just goes on for long. So is there, in your practice, have you seen a shift over the last couple of years, particularly when a lot of noise has been made?
I wish, Paula, that I could give an answer which you like and the audience would like to hear, to say that there is a perceptible shift. There is a perceptible shift from a policy perspective, from implementation of the policy. And remember, this circular is just about 2 months old. Therefore, it has not yet seen the light of implementation. But unfortunately, my experience with the tax office does not give me too much of enthusiasm. And just carrying on to your question, if I look at the next slide, the issues which I raised earlier. So what happens, for example, when there is a funding round where valuation is both resident and non-resident? one of whom you are accepting and the other you are not. Both money is coming at the same price. What happens? And again to your question, I use that word unfettered power to the tax authorities to reject a valuation methodology continues, and therefore litigation is not ruled out. However, I must say that in all fairness, your ability to defend a litigation is far better today compared to earlier. To go back and say, earlier you had only DCF to fall back upon and say why that DCF is justified. Today you can go back and say there are other optionalities, and I do fulfill that optionality. Sorry. Then the question is very interesting one, which is from a FEMA perspective, I cannot issue shares at less than market value. So FEMA puts a perspective to say that if the shares are worth 100, I cannot issue at a rupee less. Income tax goes back and says, if you issue at more than fair market value, then you have a 10% room headway, which is the sort of a margin safe harbor which has been granted to you. And if you receive anything more than that, then you have a litigation. So I'm stuck to say that I have to determine that exact fair market value, and I have to raise funds at that price. And Paula, you and I know that when investments happen, nobody cares a damn about your valuation methodology. It's a lot of negotiation, lot of bargaining, lot of horse trading that happens, and you come to a number. And here is an Indian guy struggling to get the maximum value. It is difficult for him to go back and say that I struggle so much to get more money from the investor. Investor is trying to bargain to get the minimum price. You keep somewhere, and then the tax office is coming back and saying, I don't give a damn about how hard you negotiated and you got a deal for yourself. But if you got a good deal for yourself, pay me taxes on that good deal. So it becomes quite a hilarious perspective in that sense. Any more questions there, Paula, or should I go to the next issue?
We can move to the next issue.
Okay. So the next question, the next incentive which we have is a tax exemption under Section 81AC, and there's a very interesting exemption. And again, it just shows, Paula, again to go back to say that how we have a right mindset, but how do we draft regulations and what actually comes out of it, and can anybody actually take advantage of it? So here what is provided is that if you are a startup and you are a startup recognized, and I'll come to that in a minute, then that startup can get exemption for 3 consecutive years out of 10 years from its incorporation. So if you are a startup which has been recognized by a DPIIT, and you are considered to be an eligible business by an interministerial board. So you have 2 recognitions. One is from DPIIT, and second, you are considered to be an eligible business by a interministerial board if you have both of those. And you are a company or an LLP, and you are incorporated between 2016 and 24, and you do not exceed that 100 crore rupee turnover, then for 3 out of 10 years, you can claim a tax exemption. Now, the eligible business, which is to be evaluated by the interministerial board, is a business of companies which are engaging in innovation, development or improvement of product or services, etc., what I have put here. You are creating employment, you are doing wealth generation, wealth creation. And again, for a ministry, why again do I need a second recognition from a ministry? Why is DPIIT itself not sufficient to have a look at it as a separate issue? But if I do all of that, then I get this 3-year exemption. So you want me to be below 100 crores of rupees. You want me to make a profit within 10 years, which I may or may not make. That profit should remain after I have absorbed all the brought forward losses. So if in the 5th year I have got for first 5 years losses, then I go to 6th year, unless I have absorbed all those losses, I cannot claim a tax exemption. And then I do that. Then while I get a tax exemption, I am not exempted from MAT credit. And therefore, what is the practical ability to claim this exemption? And again, there are those other exemptions, other requirements. You are not formed by split up of reconstruction of a business, which if I am, then DPIIT itself would not grant me a recognition. Now, after having convinced DPIIT and the interministerial board, I need to convince the tax officer that I am not constructed by splitting up of a reconstruction of a business in existing or any plant and machinery used in the earlier year. So everything done to say I will give you a tax exemption, and then all the conditions which are put to see how I really cannot really get it. And practically, therefore, what has happened is out of 1,15,000 recognized startups, 2.5% have actually claimed a tax exemption. 97.5% have not been able to claim this tax exemption at all. Just again, the question is that this 100 crore criteria, that nobody is aware that if I have got this exemption for the year 5, 6, and 7, then year in the 8, 9, and 10, if I thereafter cross the 100 crore turnover, then what happens? Nobody knows whether everything that I have got I will have to refund, etc., etc. And the time that it takes in getting the interministerial board's approval is simply breathtaking. It takes anywhere between 1.5 to 2 years to get that recognition from the interministerial board. Then we go to the next so-called benefit available to a startup, which is Section 79. Section 79 applies to every company which is not widely held. And what the law provides is that if you are an entity which has incurred losses and later on those losses are to be carried forward or set off against profit, you have to examine whether at least 50% of the shareholders continue to be shareholders in the year in which the losses are being set off against the profit. So simple requirement applies. It has been there for years on end to say you have got losses, you are carrying forward those losses. In a later year, you have got a profit. In that year, has there been a change of shareholding by more than 50%? If so, the losses lapse. You cannot set them off against profits. You have to pay tax on your profits. And I've just given a small example to illustrate how it works. So in our example, we have got a business in year 1. A and B are the two people who incorporated the company. They had 50-50 shareholding. In year C, and in every startup you go on having more and more funding. In year C, there is an additional funding, and that funding is to the extent of 50%. The losses do not lapse because A and B continue to hold 50%. Now D is introduced, and D is given additional holding. Now A and B have ceased to be more than 50% shareholders, are only holding 40%. Section 51 condition, Section 79 condition is invoked. 51% shareholding is not there, and therefore the losses will lapse. This will not apply to a startup for the losses which are incurred up to the first 10 years, which is a very, very welcome thing. If provided again, you are recognized by DPIIT and you are recognized by IMB, if both these fulfill, then this is a very, very welcome thing. This is something I was personally involved in representing to the government on behalf of FICCI, and I'm glad that this has been recognized and allowed to be carried forward.
But this is quite welcome because I think this is really a big thorn. Is there a logic for this interministerial panel, Dinesh Bhai? Is there talk of replacing it with some sort of a startup mission or a Ministry of Commerce or something?
Interministerial board itself is supposed to be a startup board. It is supposed to be somebody which facilitates. So there is no, and I have not heard any noises being made to say, can this be represented by any other panel?
Okay, because that seems to be a big sort of a roadblock.
Other than that, this is a very, very welcome provision. So if you have recognition from DPIIT, if you have recognition from the MIB, then you are kosher. Section 79 does not apply to you.
All right. So this is a big clarification because there is a lot of confusion around this. So thank you for this.
Okay. The next one which we have, which is a benefit granted to startups, is on, ESOP taxation. And ESOP has been a big challenge. In fact, there was a parliamentary committee which was constituted generally for everybody to say that ESOP taxation should happen only when the values are realized rather than when the ESOPs are granted. Because when there is no money, how are you going to pay taxes on the benefit that you have got from ESOP? That has not yet been implemented. For startups, what is now provided is that if there are any ESOPs, payment of tax on exercise, the payment, so tax liability will be computed on the date of exercise of the ESOP. However, the payment is deferred for a period of 4 years. So you have to sell off within a period of 4 years so that you can get liquidity to make the payment. Or if you sell the shares earlier than 4 years, then you have to pay taxes immediately thereafter, or if you cease to be the employee of the company. Makes sense? At least this is a huge benefit compared to what everybody else pays. You don't have to pay taxes immediately on a perceived perquisite or on the basis of mere exercise. If, however, you have not done so within a period of 4 years, which is not a benefit available to anybody else, then you've got to sell, realize liquidity from elsewhere and make the payment. But otherwise, this is sort of a very much a very welcome benefit, like in the context of Section 79. Finally, there is long-term capital gain tax exemption available for investment in startups. Again, we are aware of it. The exemption is available to a maximum investment of rupees 50 lakhs in specified startups and notified funds issued before 1st April. But let me quickly turn to the last item. We are running out of time, which is on flipping the structure, something which I see ever so often. And we see two types of situations which happen here. One is a situation where a startup has been set up as an Indian company, attracts a lot of funds. Most of the funds have come from funds which are located outside of India. And then the startup believes that it wants to list overseas. And it comes back and says that I would like to externalize my structure, become an overseas company, which might very well work from overseas investors because they might have their own exemptions. And even if the value has gone up, if there is a swap happening, their investment is an Indian company, and if the shares are swapped into an overseas company, they may be sort of tax neutral and they don't have any FEMA implications. From an Indian promoter issue, this becomes a very major issue for two reasons. One is the FEMA guidelines and the ability to make investment in an overseas company, number one. And second, if you swap the shares, the swap is considered to be a transfer. And if the value has gone up, which it would have, which is why you are doing the entire exercise in the first place, then you end up paying taxes right away. And lot of restructuring that we do, Paula, whether it is in the form of mergers, demergers, slum sales, are precisely to avoid payment of capital gains tax, etc., on swap and to get out of the FEMA requirements on a swap. And we see that ever so often a lot has been written about this in the media. At one point of time, I remember Mohandas Pai had written an article and it became a subject matter of huge social media discussion. But to come back and say that this is something which we see ever so often, because when you started the startup, what objectives you had and what happens in due course changes, and you want to be an overseas structure. And we see a reverse one where people want to reverse flip and they want to shift their base to India from a foreign location. We are aware of Flipkart, for example, and others, where you come back and say that what is the advantage that I have to be in an overseas company? Remember that we have the Vodafone amendment to the Income Tax Act, which says that if you have got an overseas company and the overseas entity derives more than 51% value from operations or assets in India, that will be considered to be an Indian company. So actually having an overseas company might actually be counterproductive, because when you realize the capital gain, you will end up paying taxes in India, and that taxes do not become a part of the cost of the Indian shares, and therefore when if India is sold again, you end up paying a second level of tax. So you have two layers of taxation, and therefore you might as well merge the foreign company into the Indian company and become just one, so that you don't end up paying two layers of taxes. Again, there are foreign jurisdictions which permit merger into India and others which don't. And therefore, very often we find complex restructuring exercises, and I don't think I can explain all of this on a conference like this. But just to explain to you, we find situations where overseas companies are relocated into jurisdictions where cross-border merger is permitted, and then we see cross-border mergers happening into India. We also find people wanting to onshore using the gift city. Again, this has not happened practically. In theory, it is very much possible, but this is something that the expert committee on gift city has recommended, so that people can really not have to swap into India, but get into gift city, which is in India and yet outside India. But a lot of things that we see from foreign investors, both on both sides, primarily because they said, when you were set up, you thought you want to list in India, now you want to list overseas, or you want to raise funds overseas, and the foreign investor doesn't want to invest in an Indian company, is looking at investment only in a foreign company, or having set up an overseas company, now you feel that the value is in India and you want to sort of have a single entity. So both situations of what we have seen over a period of time. The final thing, for a couple of minutes, I would just think and then move on to question answer, is characterization of advertising expenses. And this we see as a major litigation coming up for startups. All startups spend huge amount of funds trying to do a brand building exercise. And the tax authorities have now come back to say, and this is in the celebrated case of Flipkart, which has been reported in the media, to come back and say that when you incur huge amount of expenditure on advertisement and marketing, and you are building up a brand, that expenditure is not revenue in nature, but is capital in nature, and you can, if at all, get a depreciation on it and nothing, which is totally incorrect. It's totally incorrect interpretation of law. This is a revenue expenditure which ought to be allowed, as has been held by the income tax at Bangalore. But we see a lot of litigation happening on this. And again, there's a lot which one can do in terms of planning to show that the board papers, etc., do not talk about brand building as a reason for doing a branding exercise, but really to say that it is needed for day-to-day business operations of the company. So those are the things that are concerning startups. Let me just put up this list rather than talk about it. Maybe time to throw up the floor for question answer, Paula.
Yeah. Thank you, Dinesh bhai, and please put up your questions in the Q&A box or in the chat, so we can take them one by one. But just Dinesh bhai, to go back, let's start from towards the end. You mentioned about flipping and some jurisdictions. Which are the favorable jurisdictions from where this is rather easy? We see a lot of companies either because of people like Y Combinators and others who list in US, who register in US or Singapore. Flipkart, etc., have done Singapore. Do these continue to be good jurisdictions to flip back and forth? And the other question related is, are there regulatory compulsions for companies to be registered in India in certain sectors? And is it still as difficult to sort of do the reverse flip?
Which overseas jurisdiction to choose is not a difficult thing. It could be Singapore, it could be whatever. That depends on what. So let's say, first of all, you want to externalize. In an externalization situation, you will come back and say, I want to list, say, for example, in USA, if that is my objective. Okay.
Yeah.
Then I could be anywhere. I could be in Bahamas, I could be in Cyprus, I could be in Singapore. That's not important. The barriers are, how do I overcome the requirements of FEMA, which does not permit a resident to hold shares overseas except in a specified manner? And how do I avoid my capital gains tax liability? Because the moment I swap my shares in Indian company for shares of a foreign company, I will have to pay tax here and now, and that could be a huge liability. That becomes more important rather than choice of a jurisdiction. When one speaks about a reverse merger into India and sort of flipping the structure back to India, the only thing which becomes important, Paula, is that India does not, or rather India permits a cross-border merger, but not all other foreign jurisdictions permit a cross-border merger. So let's assume that I am a company in Singapore. Singapore does not permit a cross-border merger into India. Then I might have to relocate that Singapore company elsewhere to a jurisdiction where cross-border merger is permitted, and then you merge into India. Becomes a fairly complex exercise.
And the new FEMA regulation that came out, which is actually even our LRS, we are now not able to, at least the banks are not allowing us without RBI permission to invest in foreign entities. And what happens where we have invested in Indian companies which have already flipped, and this was before the circular came, is there still can we still continue to hold shares there? Do we have to, and if you want to follow on, can we still do it? Or there is a lot of confusion around this FEMA last circular that has come as well. So if you could clarify that.
So, Paula, your question, I'll break it up into two parts. You are an investor in an Indian company. The Indian company decided to flip the structure overseas, and you got shares of the overseas company. Assuming for a moment that that is the situation, you would need to go back to Reserve Bank and ask for a permission to continue to hold the shares, which permission Reserve Bank has been known to grant. But you need Reserve Bank permission to be continuing to hold the shares in the overseas entity. If you talk about any follow-on, that requires specific Reserve Bank of India permission, which is unlikely to be available.
So just to make it clear to all the investors and also to founders out there, if you are registering a company out of India, you yourself as well as your Indian early investors or Indian non-institutional investors will not really be able to invest in that using the LRS route. So that stops, also if most of your revenue comes from India and you are a registered company outside of India, is there any other confusion there in terms of how your company is viewed, even at the early stage? I know some of the bigger companies have had this issue. But let's say I have a company, for example, which is, because it was a YC company, flipped to the US. They're in Indian school, an EdTech company, their entire clientele revenue is from India. Now, I don't know how that is viewed today.
So, again, without being too technical, Paula, we have Section 9 of the Indian Income Tax Act, which essentially provides that if an overseas company derives more than 51% of its value from operations in India, it will be regarded as an Indian company. And when the shares of that overseas company are sold, they'll be deemed to be sale of shares of an Indian company, and capital gains tax will apply in India. Okay. So, and again, just to make it a little bit more interesting, you are talking about an EdTech company which has got holding overseas, operations only in India. But what if that EdTech company had IP which was located overseas and operations in India? Could one do a valuation to come back and say the entire value is, or more than 51% value is in the IP and not in the ground level operations in India? Number of things which arise there. An advisor.
Correct. We have a question from a founder who says, how does one keep on top of all the regulations? Because it's almost, you're tempted, for example, to become the debit. And then, for example, I think this founder is saying they had to then have a subsidiary to hive off one IP and the other, and they couldn't do it, or they would lose the debit status. So they didn't realize that. So now they're in a soup. So I think overall, these are small companies. What is the best way for them to really get, all this information?
Could you come back with that question? I don't think I followed it fully, Paula. Sorry.
So, if you are a DPIT registered startup, recognized startup, then as you said in the early part of the conversation, you cannot have another subsidiary, right? So this company, for example, spun off a subsidiary because they wanted to have one IP, which was kind of different and looking at it in one.
Okay.
So then they did not realize that they lost their DPIT status because they had done, the subsidiary. So broad question is, what is the best way? Is there a way for, even as in early investors, how can we also guide, or for founders to really figure out what the rules are? I mean, they are so small at the onset that it's very hard to get really good advice.
So I would put two propositions there on the table, Paula. One is that the approval granted by BPIT itself puts this as a prohibition to say you will not have a subsidiary, and you cannot say I didn't read the approval, number one. Number two, assume for a moment that you spun off a subsidiary, okay, and you recognize this within a short period of time, 3-6 months, not a year or two. You could actually go back and merge it with retrospective effect. You could merge a subsidiary into the parent with retrospective same day on which you created and get it out of the system and possibly not lose your DPIIT status.
Yeah. No, I think the broad question is, I think people need to be cognizant when they start a company that you have to follow all the rules. You have to have some advice. I guess even if you are small and still starting up, you need to keep your nose clean. You have to focus on governance and compliance from day one. I think, as we like to tell all our companies, have a board which can guide you, even if you're small, especially when you raise external funding, to protect on both sides, because we've all been on sort of the wrong end of the stick many a times. And then last question on exits. You did talk about the long-term capital gains. There is another question on, if you have a foreign investor, and I believe the law is that the valuation for a non-resident cannot be higher than that of cannot be lower than that of a resident. So if in case there's a company needs to wind up, how does one really get rid of shares at a low cost? You have to really, if below book value sale for the foreign party is not possible, is it?
So when you say you want to wind up the company or you want to get rid of the share,
let's say sell below the book value, because of somebody needs an exit. I think that's the question. Somebody needs an exit, and there is somebody who will buy, but they cannot buy below book value if it's a non-resident. Is that correct?
Yeah. So a resident cannot sell shares to a non-resident at less than fair value.
Less than that. But you can sell to a resident.
Yes, one resident can sell to another resident, in which case Section 56 will apply if it is less than fair. So the earlier point was regarding FEMA. So yeah. FEMA. So one is Section Income. FEMA puts a prohibition on what you can do. Income tax puts tax consequences. Right. So under FEMA, you cannot do a transaction where a resident sells shares to a non-resident at less than fair value. So let us assume that a fair value is 100. A resident cannot sell to non-resident at less than 100. Now, if the fair value is 100 and a resident sells to another resident at 80, then one has to pay tax on 20. But the transaction can be done. The two are different situations.
And the last question, Dinesh bhai, is on, a lot of startups fail by definition. In India, closing of companies is exceedingly hard. What is the best way to structure a company so that one can actually even book a loss, right? Sometimes it gets exceedingly difficult to just close a company.
So, very clearly, a limited liability partnership becomes a very interesting model. And while the bankers are still not used to, and raising funds from third parties becomes a challenge. So a VC will not come and invest into a limited partnership. But if you are not raising external fund, liability partnership is a great way to operate a startup. It removes all the rigmaroles of board meetings, compliances, change of auditors, women directors, nothing. You are sort of free to do what you want to do. But when you are raising third-party funds, you will have no option but to get it into a company. In which case, winding up, while it is still difficult, but there are ways and means on which you can accomplish it practically. So, for example, again, without getting too technical, Paula, the one way to do it is that can you, pending winding up of a company, distribute all the assets and then only the shell remains, and the shell may take whatever time, doesn't matter. Possible to do it.
Well, thank you so much, Dinesh bhai. We are just about out of time, and several people have asked for your, the YouTube video so that they can go through your presentation, which has been very informative. And I can tell you from first-hand experience, both as an investor and somebody who interacts on a daily basis with founders, that a lot of this information we know very sketchily. So I think this has given, the right grounding for us to actually review how we are doing things. And I think one should have more of these knowledge sessions. I think the next one could be on, what is the hot topic today is on governance, what we are seeing, what's happening at OpenAI and even some of the Indian startups. So that's another issue of boards, how they can sort of keep an eye open. But all these are technical issues that we really grapple with. And thank you so much. And I'm really heartened that somebody like Dhruva is really taking this up and going deep into it, and the advocacy that Dinesh bhai has had as through FICCI and other forums to push the angel tax issue and several other issues has really affected positively our ecosystem. So thank you again, and thank you all for joining. Over to you, Harsh.
Thank you, Dinesh sir. Thank you, Paula ma'am. Thank you everyone for joining in for today, and we'll definitely keep in mind for the next topic, ma'am, and we'll organize many such sessions.
Thank you.
Thank you everyone for joining.
And please share the PPT. I think several people
Sure.
posting on the group. Yeah.
Sure.
All right. Thank you.